In the summer of 2008, something strange began happening in American housing markets. In cities like Las Vegas and Phoenix, home prices suddenly started falling. Listings piled up. Open houses sat empty. Sellers cut prices again and again, hoping anyone would show up. But just a few hundred miles away, things looked different. In places like Washington, D.C. and parts of California, prices didn't collapse immediately. Homes still sold. Buyers still competed. The housing crash had begun. But it wasn't happening everywhere at the same time. And today, nearly 2 decades later, history may be repeating itself. Because once again, the American housing market isn't moving in one direction. It's splitting apart. Some cities are already sliding. Others are barely slowing down. And that raises a question that economists, investors, and homeowners are all asking right now. Why do some housing markets fall first? To understand what's happening today, we have to go back. Back to the last housing collapse. Back to the years before the crash. In the early 2000s, America experienced one of the fastest housing booms in modern history. Cheap credit flooded the market. Banks relaxed lending standards. Mortgage brokers offered loans to borrowers who would have been rejected just a few years earlier. Adjustable-rate mortgages, subprime loans, no documentation approvals. For millions of Americans, owning a home suddenly felt easier than ever. And the demand pushed prices higher. Year after year. Between 2000 and 2006, national home prices surged by more than 60%. But the increases weren't evenly spread across the country. Some cities exploded. Las Vegas, Phoenix, Miami. In these markets, investors poured in. Flipping houses became a national obsession. Entire neighborhoods were bought by buyers who never intended to live there. They were betting on one thing: prices would keep rising. But when the bubble burst, those same cities were the first to fall. Why? Because speculative markets are always the most fragile. When prices rise too quickly, they create a dangerous illusion. An illusion of endless demand. But much of that demand isn't real. It's temporary. It's investors. It's short-term speculation. And when conditions change, when interest rates rise or buyers pull back, those markets lose momentum first. Today, economists are seeing early signs of a similar pattern. Across the United States, home prices surged during the pandemic housing boom. Between 2020 and 2022, national home values jumped at the fastest pace in decades. Mortgage rates were historically low. Remote work allowed people to relocate. And millions of buyers rushed into the market. But again, the gains weren't evenly distributed. Certain cities experienced massive price spikes. Cities that suddenly became magnets for migration. Austin, Texas. Boise, Idaho. Phoenix, Arizona. Tampa, Florida. In many of these places, home prices jumped more than 50% in just a few years. For homeowners, it felt like a windfall. But rapid appreciation always carries risk. Because when prices rise too fast, affordability eventually breaks. And that's exactly what began happening in 2023 and 2024. Mortgage rates climbed sharply. The average 30-year rate jumped from around 3% to over 7%. Suddenly, the cost of buying a home doubled for many buyers. Monthly payments skyrocketed. Demand slowed. And in certain cities, prices started slipping. Not everywhere. Just in specific places. Once again, the crash or correction appears uneven. Some markets are adjusting quickly. Others remain surprisingly resilient. And the differences between them reveal something important about how housing markets really work. Real estate is local. Always has been. National headlines talk about a housing market. But in reality, America doesn't have one housing market. It has hundreds. Each city moves based on its own economy, population trends, housing supply, and migration patterns. When those factors align, prices rise. When they shift, markets can cool quickly. And right now, some cities are feeling that shift first. In Austin, one of the hottest pandemic boomtowns, prices surged dramatically between 2020 and 2022. Tech workers relocated. Investors bought rental properties. Developers rushed to build new homes. For a moment, it seemed unstoppable. But when mortgage rates climbed, demand cooled. Suddenly, the inventory of homes for sale began rising. Price reductions became more common. The market didn't collapse overnight. But the momentum had changed. The same story has appeared in other pandemic boom cities. Boise, Phoenix, Salt Lake City. In these markets, the combination of rapid price growth and rising interest rates created a pressure point. Buyers simply couldn't keep up. And when buyers step back, sellers eventually have to adjust. Lower prices, more incentives, longer time on the market. It's the earliest stage of a housing correction. But here's the interesting part. While some cities are cooling, others remain surprisingly strong. In parts of the Midwest and Northeast, home prices have remained relatively stable. In cities like Cleveland, Pittsburgh, and Chicago, prices never surged as dramatically during the pandemic. Because of that, affordability hasn't deteriorated as severely. Demand remains steady. Inventory remains limited. And prices, at least for now, are holding up. This difference creates a patchwork housing market. Some regions slowing, others stable, a few still rising. It's not the dramatic nationwide crash many people imagine. Instead, it's something more complex. A gradual reshuffling of housing demand across America. But this raises an even bigger question. If the housing correction is uneven, which cities are most vulnerable next? And which markets might stay resilient the longest? To answer that, we have to look deeper into the forces that truly drive housing markets. Population migration, job growth, housing supply, and one powerful factor that changed everything during the pandemic: remote work. Because the places that boomed the fastest may be the ones now facing the biggest adjustment. For a brief moment during the pandemic housing boom, certain American cities seemed unstoppable. Prices surged. Homes sold within days. And buyers, sometimes hundreds of them, competed for the same property. It felt less like a housing market and more like an auction. But behind that frenzy was a powerful shift that reshaped where Americans wanted to live. Remote work. When offices closed in 2020, millions of workers discovered something surprising. They no longer had to live near their workplace. For decades, major job centers like New York, San Francisco, and Los Angeles had dominated housing demand. People tolerated high prices because they needed to be close to jobs. But suddenly, geography mattered less. A software engineer working for a company in Silicon Valley could now live in Austin. A marketing manager in New York could move to Tampa. And thousands of workers began making those choices. The migration patterns were dramatic. During the first 2 years of the pandemic, millions of Americans relocated to lower-cost cities. Places with warmer weather, more space, and homes that seemed like bargains compared to coastal markets. Austin, Texas, became one of the biggest winners. Between 2020 and 2022, the city experienced a massive surge in new residents. Tech companies expanded their presence. Remote workers arrived from California. Investors rushed in to buy rental properties. Home prices responded quickly. According to housing data from that period, prices in Austin surged by more than 40% in just 2 years. In some neighborhoods, the increases were even higher. Homes that once sold for $350,000 suddenly approached $600,000. The city transformed almost overnight. But Austin was not alone. Boise, Idaho experienced one of the fastest housing booms in the country. Once considered a quiet mid-sized city, Boise became a magnet for buyers leaving expensive West Coast markets. California migrants arrived with higher incomes and larger budgets. Local buyers struggled to compete. Prices skyrocketed. Between 2020 and 2022, Boise's home values jumped by nearly 60%. In Phoenix, Arizona, the story was similar. The city had already experienced rapid growth before the pandemic. But during the housing boom, demand accelerated dramatically. Retirees moved in. Remote workers arrived. Investors purchased homes to convert into rentals. Inventory disappeared. Prices climbed higher. For a while, it seemed like these cities had entered a new era of permanent growth. But housing markets rarely move in straight lines. And the turning point came from a place few buyers expected. Interest rates. In early 2022, the Federal Reserve began aggressively raising rates to fight inflation. Mortgage rates followed. Within months, the cost of borrowing increased sharply. The average 30-year mortgage rate more than doubled. For many buyers, the impact was immediate. A home that once required a $1,500 monthly payment suddenly demanded $2,700 or more. Affordability collapsed, and demand slowed. But here, where the uneven nature of the housing correction becomes clear. Cities that experienced the fastest price growth suddenly faced the greatest pressure. Austin was one of the first to feel it. By 2023, the number of homes for sale in the city had begun rising. Listings stayed on the market longer. Price reductions became more common. Developers who had rushed to build during the boom suddenly found themselves competing with growing inventory. The momentum that once drove the market upward began reversing. Boise faced a similar adjustment. Buyers who had once rushed into the market stepped back. Some investors paused their purchases. Others tried to sell properties they had acquired during the boom. Inventory increased, and prices began slipping from their peak. The same pattern appeared in Phoenix. Price growth slowed, then stalled. Then in some neighborhoods, it began to fall. The shift wasn't a sudden crash like the one seen in 2008. But it was noticeable. The explosive growth of the pandemic years had clearly ended. And that raises an important question. Why did these cities become the first to cool? The answer lies in something economists often call elastic demand. When buyers move into a city primarily because it is cheaper than somewhere else, that demand can disappear quickly. If prices rise too high, or if borrowing costs increase, buyers simply look elsewhere. This is different from cities with deeply rooted local demand. Places where job markets, universities, and established industries constantly attract residents. In those cities, demand tends to remain more stable. But in boomtown markets fueled by migration and investor activity, the cycle can reverse much faster. And once momentum shifts, the effects can spread quickly. Developers may continue building homes that were planned during the boom. But if buyer demand weakens, those homes add to the growing supply. More supply creates more competition among sellers. And that competition often leads to price cuts. It's a classic housing cycle. Boom, big, adjustment. And in many of America's pandemic boom cities, that adjustment has already begun. But here, what makes the current moment particularly fascinating. Even as some cities slow down, others remain remarkably stable. In fact, certain housing markets across the United States never experienced the extreme price surges seen in places like Austin or Boise. And because they avoided the most intense boom, they may also avoid the sharpest correction. In Part 3, we'll explore those markets, the cities where home prices have remained surprisingly resilient, the places where limited housing supply and steady demand may keep prices stable even while other markets slide. Because the uneven housing crash is creating two very different realities across America. While headlines often focus on falling prices in certain cities, another story is unfolding quietly across much of the United States. In some places, the housing market hasn't collapsed at all. In fact, in several regions, prices remain surprisingly stable. Homes are still selling. Inventory remains limited. And buyers, though more cautious than before, continue to compete for properties. This contrast reveals something fundamental about American real estate. Not every market experiences the same cycle. And sometimes, the places that rise the slowest fall the least. To understand why some housing markets are holding their ground, we need to look at a part of the country that rarely dominates national housing headlines. The Midwest. Cities like Cleveland, Pittsburgh, and Detroit never experienced the explosive price growth seen in pandemic boomtowns. Home values increased, certainly, but the increases were moderate compared to places like Austin or Boise. In Cleveland, for example, the median home price remained relatively affordable throughout the pandemic housing surge. Even as national prices climbed dramatically, Cleveland homes still cost a fraction of those in major coastal markets. Because prices stayed lower, affordability remained stronger. That meant buyers weren't stretched to their financial limits. When mortgage rates rose, the impact was less severe. Buyers could still qualify for loans. Demand slowed somewhat, but it didn't disappear. The same pattern appeared in Pittsburgh. For years, Pittsburgh's housing market has been shaped by steady, predictable demand. Universities anchor the city's economy. Healthcare systems employ tens of thousands of workers. Technology companies have slowly expanded their presence. The result is a housing market that grows gradually rather than explosively. When prices rise slowly, they rarely crash suddenly. And that stability can become an advantage when national conditions change. But affordability isn't the only factor protecting certain markets. Housing supply plays an equally important role. During the pandemic boom, many fast-growing cities experienced a surge in new construction. Developers raced to meet rising demand. New subdivisions appeared on the outskirts of cities like Phoenix and Austin. Builders assumed the demand would continue. But when demand slowed, those new homes added to supply. And excess supply can push prices downward. In contrast, many older cities in the Midwest and Northeast face the opposite challenge. They don't have enough housing. Construction has been relatively slow for years. Zoning regulations, aging infrastructure, and limited available land restrict new development. That means even when demand weakens slightly, there still aren't enough homes available. And when supply remains tight, prices tend to remain stable. Another factor shaping these resilient markets is employment stability. Cities with diverse economies tend to weather housing downturns better than those dependent on a single industry. Consider a city built around tourism or speculative tech growth. If those industries slow, the local housing market can feel the shock quickly. But in places where jobs are spread across healthcare, education, manufacturing, and logistics, economic shocks are less concentrated. Demand for housing remains steady because people continue moving for work. This is why certain Midwestern and Northeastern cities are proving more stable during the current housing slowdown. But the story doesn't end there. Another unexpected group of resilient markets has emerged in recent years. Established, high-demand metropolitan areas. Places like New York, Boston, and parts of Southern California. At first glance, these markets might seem vulnerable. Home prices are already extremely high. Mortgage rates have risen sharply. Affordability is stretched. Yet despite these pressures, inventory remains remarkably limited. Many homeowners in these cities purchased properties when mortgage rates were near historic lows. Rates around 3%. Selling their home today would mean giving up that low rate and purchasing another property at a much higher cost. For many homeowners, the math simply doesn't work. So they stay put. This phenomenon, sometimes called the lock-in effect, has created a housing shortage in certain markets. Even though demand has cooled, supply has cooled even more. Fewer homeowners are willing to list their properties. And when supply shrinks, prices tend to remain resilient. It's a strange paradox. Higher interest rates have slowed buyer demand, but they've also reduced the number of sellers. The result is a market that feels frozen rather than collapsing. Homes sell more slowly. Negotiations become tougher, but prices don't necessarily crash. This dynamic helps explain why the national housing picture looks so uneven. Some cities face rising supply and falling demand. Others face limited supply and steady demand. And those differences are shaping how the housing slowdown spreads across the country. But there is one more force quietly reshaping the housing landscape. Demographics. America's population is still growing, and millions of younger households are approaching prime home-buying age. For years, economists have predicted that millennials, now the largest generation in the workforce, would eventually drive housing demand. That moment has already begun. Despite rising interest rates, many younger buyers still want homes. They may delay purchases. They may adjust their budgets. But the underlying demand remains. And that demand creates a floor under certain housing markets, especially in cities with strong job opportunities and reasonable affordability. Which brings us to the biggest question facing the American housing market today. If the crash is uneven, if some cities are falling while others remain stable, what happens next? Will the correction spread across the entire country? Or will the housing market continue splitting into two very different realities? Housing markets rarely collapse in a single moment. More often, they change slowly. Momentum fades. Buyers hesitate. Sellers begin adjusting their expectations. And over time, the market finds a new balance. That is the stage many American cities appear to be entering now. But the future of this housing correction depends on several powerful forces that are still unfolding. Interest rates, migration patterns, housing supply, and perhaps most importantly, psychology. Because housing markets are not driven by numbers alone. They are driven by human decisions. The decision to buy, the decision to sell, the decision to wait. And right now, millions of Americans are choosing to wait. For buyers, the hesitation is obvious. Mortgage rates remain far higher than they were during the pandemic boom. A buyer who could once borrow money at 3% now faces rates closer to 7%. That difference changes everything. Monthly payments rise dramatically. Budgets shrink. And homes that once seemed affordable suddenly fall out of reach. For many buyers, the logical response is simple. Wait. Wait for rates to fall. Wait for prices to adjust. Wait for the market to become clearer. But sellers are waiting too. Many homeowners locked in historically low mortgage rates during 2020 and 2021. Selling their homes today would mean replacing that loan with one that carries a much higher cost. The financial penalty can be enormous. And so millions of homeowners are choosing not to move. They stay where they are. They postpone upgrades. They delay downsizing. And by doing so, they reduce the number of homes available for sale. This strange standoff between buyers and sellers has created a housing market unlike any seen in decades. Transactions have slowed sharply, but prices have not collapsed nationwide. Instead, the adjustment has been uneven. In some cities, particularly those that experienced the fastest price growth during the pandemic, markets are cooling quickly. Inventory is rising. Price cuts are becoming more common. Buyers are negotiating again. In other regions, however, housing supply remains so limited that prices have barely moved. The market feels frozen rather than falling. This uneven correction could continue for several years. But over time, one factor may reshape the entire landscape. New housing supply. Across the United States, homebuilders responded aggressively to the pandemic housing boom. Construction permits surged. Developers purchased land and began planning new communities. Many of those homes are still being completed today. In markets where demand has slowed, this new construction could increase competition among sellers. Builders may offer incentives, price reductions, mortgage rate buydowns, and as new homes enter the market, existing homeowners may have to adjust their expectations as well. But construction alone will not determine the future of housing. Population trends may prove even more powerful. For decades, Americans have gradually migrated toward the Sun Belt. States like Texas, Florida, Arizona, and North Carolina have attracted millions of new residents. Lower taxes, warmer climates, expanding job markets. These long-term trends continue to support housing demand in many of those regions. But the pandemic accelerated migration at an extraordinary pace. Cities like Austin and Boise experienced growth far beyond historical norms. And rapid growth often invites rapid correction. If migration slows or reverses slightly, housing demand in those cities may stabilize at lower levels than during the boom years. That doesn't necessarily mean catastrophic price crashes, but it could mean slower growth, longer selling times, and a gradual rebalancing between buyers and sellers. Meanwhile, other regions may quietly gain strength. Cities that remained affordable throughout the pandemic boom could attract new attention. Midwestern metros, secondary northeastern cities, places where housing remains within reach for middle-class buyers. These markets may not experience explosive price increases, But stability can be powerful. In uncertain economic environments, buyers often prioritize predictability over speculation. And that shift in mindset could shape the next decade of American housing. Which brings us back to the central idea behind this story. The crash is uneven. It always has been. The housing market is not a single machine moving in perfect synchronization. It is a vast network of local markets, each shaped by its own economy, its own population trends, its own supply of homes. When national conditions change, when interest rates rise or migration patterns shift, those local differences become visible. Some cities feel the pressure immediately. Others remain stable for years. And a few may continue growing even during broader downturns. For homeowners, investors, and policymakers, this reality carries an important lesson. There is no single narrative that explains the entire housing market. Every city tells a slightly different story. Some markets will cool. Others will hold steady. A few may surprise everyone. But beneath those differences lies one enduring truth about real estate. Housing has always been one of the most powerful forces shaping American wealth. Homes are not just places to live. They are the largest financial asset many families will ever own. And because of that, the housing market commands extraordinary influence. It shapes local economies. It affects national policy. It determines who can build wealth and who cannot. Even during periods of correction, that influence remains untouchable. Prices may rise. Prices may fall. Cities may boom. Cities may cool. But the power of housing in America never truly disappears. It simply moves, quietly shifting from one city to the next.